Hello and welcome to Business Lunch. I'm Nisha Poddar and with me as always is my co-anchor Pavitra Parekh. So Pavitra, let's take a look at the markets. And yes, we both have got the colors really right. Okay, our markets are really zooming in trade after the carnage that it saw yesterday. And yes, some bit of that global uncertainty seems to be lifting at lower levels, and therefore a secular move towards upwards is what we are seeing at the moment. 17,630 odd levels, 1.8% up when it comes to Nifty 50. Take a look at the other indices as well. Sensex up 1.9% in trade. Bank Nifty is the one which is leading the charge, and I'll come to some of those financials which are not necessarily adding to Bank Nifty but definitely are really lifting Nifty up. So 2.3% up on Bank Nifty at the moment. Mid-cap universe also looking good with 1.5% gain, but slight underperformance, but really can't complain much. It's the green on the screen which is really keeping the momentum alive. But in terms of volumes, tomorrow being a market holiday, we have to really see the overall participation. Advance decline ratio heavily in favor of the advances. Two stocks which are really taking my attention are Bajaj Twins, zooming up in trade, over 3 to over 5% up in trade. And also keep an eye out on Reliance Industries, market digesting the AGM announcements. And yes, that stock has also gained in trade today. Pavitra.
Oh, absolutely. And after being, an underperformer in the morning, now you can see that stock has really shot up. Of course, otherwise, if you take a look at the market, this is still ruled by the auto players. So some of the bigger names will be up for you. It's not just the Nifty auto pack, but if you take a look at something like an Igarashi Motors, Atul Auto, these stocks are really surging in trade. Real estate is where you're seeing another bunch of gains come through. So something like a DLF is up over 3% right now. The other real estate stocks also doing quite well. So whether it's a Brigade, Prestige, all of those holding well in the green. In the past couple of minutes, you've seen quite an up move in the IT pack. So take a look at that. It was, again, underperforming in the morning, but right now, something like Tech Mahindra up 3.7%. And the index has also moved up significantly. Of course, on the downside, relative underperformance coming in from some of the pharma names today. So they are looking quite tepid in trade compared to what's happening with the rest of the market. But with that, let's move on and bring you another important story. This week, the long-awaited demerger of Piramal Enterprises, Pharma, and the financial services business is set to take place. The conglomerate, which currently houses both businesses together, is set to list the two entities separately. They traded as a combined entity for the last time yesterday, and the listed entity will now only contain the financial business, while the pharma business is expected to be listed in Q3 of FY23. So Ekta is here with all of the details on this one. Ekta?
Well, yes, the demerger record date is set for the 1st of September 2022. Shareholders of Piramal Enterprises will receive 4 shares in Piramal Pharma for every 1 share held in Piramal Enterprises. The market cap of the pharma entity eventually is expected to be around 24 to 25,000 crores, which is a premium to the 18,000 crore valuation it had been given in 2020 when Carlyle bought 20% stake for around 3,700 crores, which in fact was one of the largest PE deals in the pharma space. The pharma entity has 3 verticals: the contract development and manufacturing, or CDMO arm, which is basically majority of the business. It entails drug discovery, development and commercial manufacturing. The other 2 verticals are complex hospital generics, which contains inhalation, anesthesia and injectables, and the India consumer arm, which basically houses brands such as Saridon and Lactocalamine and iPill, brands which you and me recognize and know. CLSA expects a listing by mid of October. The brokerage is valuing the company at 1,030, which should translate to around 206 rupees per share for the pharma business on listing. They look forward to the listing as they expect more disclosures, financial statements for greater insight on the pharma business once it does hit the markets.
All right, thanks Ekta for all those important details. But remember, the demerger is the outcome of the succession planning at Piramal Group. Looks like it's a season of succession plannings, because that's one of the big takeaways from Reliance Industries AGM yesterday as well. So let's focus on that particular counter and that company, and the stock is really gaining in trade today after digesting most of the big announcements made. But Sonia is right here to take us through the key takeaways and also what are the brokerages really making of it. Sonia.
Well, thanks a lot for that. As you rightly pointed out, there is a crystal clear roadmap now from Reliance Industries for various verticals, and a succession plan has also been put in place. Most brokerages are quite positive on the stock post the AGM and have target prices which are much higher than the current market price. The target prices range from anywhere between 2,800 all the way to about 3,250. Now, what are the key takeaways this time? Especially for Reliance Jio, there is a big roadmap that has been put in place. Jio will be launching the largest 5G network by Diwali of this year. In fact, there will be a pan-India rollout for Reliance Jio, and that coverage is expected by 2023. Now, for this entire exercise, there will be a 2 lakh crore investment that will be made by the company as well for the 5G rollout. Apart from this, of course, the other verticals also assume importance. The big surprise came in the form of the FMCG business that Reliance will be launching this year. Remember, that will be under the retail umbrella, and retail has been growing at a very fast pace. Despite a challenging year, retail saw 25% growth on the revenues and EBITDA in FY22. Apart from that, if you look at it, there are some big expenses that they will be making, or big investments they'll be making in the oil to chemicals business. 75,000 crores is the amount that they'll be investing over the next 5 years in order to grow this business, and all of this put together will help Reliance double their value by 2027. A couple of other things, of course, was in the form of Reliance Jio platforms launching Jio Mart on WhatsApp. They're partnering with Google to launch 5G smartphones. So these are a couple of things on the horizon as well. But the biggest takeaway, according to me, is that the succession plan has now been crystallized. It has been put into place. And this is a big green flag from a corporate governance point of view, especially for continuity of the business. The succession plan will come up for you on your screen. Akash and Isha will be joining Jio and Retail, will be heading Jio and Retail respectively, while Anant will be heading the new energy vertical, in which large amount of funds will be pumped. Back to you.
All right, Sonia, thanks a lot for taking us through all of those key takeaways from the Reliance AGM, as well as what brokerages are now saying about the stock. But with that, let's move on and bring you some important views in the market as well. Earlier today, we caught up with Sanjeev Prasad of Kotak Institutional Equities. So listen into what he has to say on the market, on Reliance, and on some of the larger banks as well.
As of now, things look okay, I would say, for the economy. In fact, pretty decent for the economy, but I guess the view on the market is constrained simply by high valuations. Not just for the market, but if you look at on a bottom-up basis for quality/growth stocks that you typically want to own in India. So I don't think growth is an issue. You will see, challenges in certain pockets. For example, consumer discretionary may be a bit soft for the next few quarters. But other than that, I don't see too much of an issue as far as growth is concerned in India. We've had a positive view on the stock for some time. Fair value is about 3,000 rupees. So that doesn't change with announcements in the AGM. So these are clearly growth areas which the company identified. And I think there are immense opportunities in the new energy vertical. And Reliance seems very well positioned to participate in that, given the fact that it has the capital, it has the technology, it has the talent to achieve all that. So if there's one entity I would like to place the bets on. Again, financials is something where valuations have been more reasonable compared to other growth quality stocks in the market. You look at HDFC Bank after the merger with HDFC, again adjusted for the value of its investment in various subsidiaries. It is available about 2.2 times by 24 basis. So I think banks, at least the tier 1 banks, still have reasonable scope for re-rating.
All right, on that note, let's slip into a short breather on Business Lunch. But remember, when we return, Ashok Leland also announces today 2 additions to popular LCV brand Bada Dost. We get you details and management commentary after this very short break. Stay tuned.
आग को फैलने से रोकना मुश्किल है, पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाई क्लब प्राइम आग से बचाए।
लीडिंग लाइट मतलब?
लीडिंग लाइट यानी जिसके परफॉर्मेंस में दम हो, जो हर रोल में फिट हो और हर घर में हिट हो, जैसे सिस्का एलईडी। सिस्का एलईडी, लाइट ईयर्स अहेड।
नई कार खरीदने से पहले एको इंश्योरेंस कंपनी चेक करे और 50,000 तक बचाए।
Hey guys, welcome back. You're still tuned into Business Lunch, and let's now talk about the auto sector. Heavyweight Ashok Leyland has launched 2 new variants of its popular LCV range Bada Dost as it looks to expand the LCV portfolio and gain market share. So the Bada Dost i1 is priced at 7.9 lakh rupees, while Leyland is offering the i2 variant at 8.63 lakh rupees. Now both of these models boast of a wide deck and other high-end specifications as well. Note that the company has sold over 35,000 units under the Bada Dost range since its launch 2 years ago. In fact, on this very launch, Sonia caught up with Rajat Gupta, who's head of LCV business at Ashok Leyland, and began by asking him which sub-segment within the light commercial vehicles the company would target with this launch, and also whether this would be offered with both fuel options, that is with diesel as well as CNG. So listen into that chat.
We are launching Bada Dost i1 and i2, which is in 2.5 ton and 2.8 ton segment. And just to talk about Bada Dost is a platform which we launched 2 years back, and that time we unveiled 2 products, which is i3 and i4. Actually, it was 3 ton and 3.5 ton segment, and it became instant success among the customer because it is designed keeping customer experience and customer comfort in mind. Now, to answer your second question, as of now, it is in diesel version, and towards the last quarter, you will see CNG version of Bada Dost as well.
Okay, so post this launch and including the previous launch of Bada Dost, can you help us with what the addressable market is in the LCV space and what kind of growth are you looking at Ashok Leyland?
Yeah, so these products will be placed in sub-segment of 2 to 3.5 ton in the LCV space. And TIV growth is beyond our expectation. We expected TIV to grow at about 10 to 12%, but actually post-COVID, I am seeing a huge growth, which is growing at about 16 to 18%. So I am expecting that the year end would be around 16% growth in TIV segment, which is much better than pre-COVID levels.
Okay, so 16% growth in the TIV segment and demand is very strong. How many more light commercial vehicle products can we expect from Ashok Leyland stable this year?
See, we have filled up the entire segment 2 to 3.5 with all the diesel versions. Now, in CNG, we have only those one model. Now, we will be launching 2 more products on CNG, Dost Plus CNG as well as Bada Dost CNG, which will offer higher power in CNG segment.
Okay, so can you just help us with what is the market share currently in the LCV segment that you enjoy, and with these new launches, what are you targeting in terms of market share by the end of the year?
It's anybody's prediction, but as of now, market share is about 20.3% in LCV 2 to 3.5 ton segment, and of course, the launches will add to it.
All right, staying with the auto sector now, sources tell CNBC-TV18 that the government has begun taking action against electric vehicle companies which are flouting the FAME criteria. In fact, our colleague Parikshit Luthra has been tracking it closely, joins us on the phone line with more information on this. Parikshit, which are the companies which are being probed under this, and what could be the consequences?
Over the last 3 to 4 months, there have been a number of complaints which have gone to the Ministry of Heavy Industries, Ministry of Road Transport, about electric vehicle makers, two-wheeler makers, which have been taking FAME subsidies, but are actually not meeting the localization criteria or the domestic value addition criteria, which is essential for availing FAME subsidies. There have also been reports that these are companies which are not selling made-in-India products. So some of these complaints have been verified and action has been taken. We can tell our viewers that we're learning from our sources that the government has held back or put on hold subsidies for companies like Hero Electric and Okinawa. The subsidies that will now be retrieved from these companies or taken back would be to the tune of 50 to 60 crores. And these will be deducted from any future payments to these companies. what sources are telling us that mechanisms have now been put into place to instantaneously identify any kind of discrepancy in submission of DVA data, put a stop to disbursement of subsidies till these companies furnish the right data. So all these checks and balances have been put in place ever since the recent EV fires took place, and the government is now monitoring the DVA data for all these companies very closely. We also hear that apart from Okinawa and Hero Electric, there are a few other complaints that the Ministry of Heavy Industries is looking at very closely right now, and will take a call on soon as well.
All right, Pariksha, thanks a lot for getting us all of the details on this important story. So the government has started taking action against companies which are flouting the government's FAME criteria. But with that, let's move on and talk about a JP Morgan report, which says that disbursements have picked up for auto financiers as pent-up demand returns after a period of 4 years. So Abhishek is here with all of the highlights from that report. Abhishek.
Well, JP Morgan has written a note on auto finances wherein they say that, the disbursers are picking up as pent-up demand has returned. So they say that higher industrial activity as well as rural recovery and positive property cycle could drive the disbursers growth going ahead. They say that, major auto finances have seen a loan growth of around 7% per annum over the last 3 years, which compares to a 17% CAGR in growth that they saw between FY11 to FY19. They say that, higher crude price could affect the operators' profitability. However, banks appear to be better placed in protecting margins as well as capturing a market share in this cycle. So they say that they expect a stock rotation in terms of YTD performance that has been seen so far. They are underweight on Chola as well as MMFSL, while they remain neutral on Shriram Transport and overweight rating on IndusInd Bank. So they expect growth and ROE differential to narrow in spaces, which should also lead to narrow in the valuation gap that is there between NBFCs and the bank. Back to you.
All right, Abhishek, thanks a lot for getting us all of the highlights of that report. With that, we're going to get into another short break. But as we do that, here's a quick reminder for our viewers. It's that time of the year again. Money Control Pro's Financial Freedom offer is back for you and with added benefits. So you can get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brand. So grab the benefits now only on the Money Control app or website.
Welcome back. You're watching Business Lunch, and take a look at Nifty 50 at the moment, gaining ahead 1.91% up, and yes, momentum is looking quite good. Moving on to an important development then, the Shrey Group resolution. Well, the companies finally received serious bids as deadline for the resolution ends, and Ritu Singh has been tracking it closely, gets us all the latest details. Ritu.
Well, thanks for that. In a surprising turn of events, London-based Verde partners and New York-based Arena investors have now come together to jointly bid for the Shrey twins, which is Shrey Infrastructure Finance and Shrey Equipment Finance under the Insolvency and Bankruptcy Code. And the second bid that has come in when the deadline ended is from a little-known HNI consortium that comprises of two individuals by the name of Sean Randhawa and Rajesh Viren Shah. But important to note is that while Arena and Verde have submitted the EMD, or the earnest money deposit, along with the bid, the Randhawa consortium has not, which means that this HNI consortium could be disqualified from the process, leaving Arena and Verde as the only sole serious bidders for Shrey. As the next step, the lenders will soon convene a meeting and evaluate these bids and start negotiations with Verde and Arena, and if at all the Randhawa consortium does qualify with them as well. Remember, over and above whatever these consortiums offer as the final accepted bid, there will be about 2,000 odd crores of cash that is sitting on the books of Shrey, which will also count as recovery for the lenders, which have made claims of over 32,000 crores from the Shrey Group companies. And this includes your Canara Bank, State Bank of India, Union Bank, PNB and others. The only bone of contention is about 5,000 crores of transactions which have been, described as fraudulent. The treatment of those remains to be seen. But for now, only one, bidder is emerging, and that is Arena and Verde.
All right, Ritu, thanks a lot for getting us the latest on the resolution of the Shrey twins. But moving on now to some exclusive opinion coming in. In a first, Chairman of the Central Board of Direct Taxes, Nitin Gupta, has spoken to CNBC-TV18's Tim C, and he shared the future plans of taxation policy, whether the taxpayers' burden can be reduced going forward. So let's listen into what he had to say on that front.
Right now, against the budget target of 14.20 lakh crore, we have achieved collection of more than 4,75,000 crore, which is at the growth of around 33%. The gross collections are still better with a growth of around 38 to 39%. In spite of more refund outgo, which we want that should be enhanced, the collections are very robust at the and going at the rate of around 33%. Corporate tax as well as personal income tax, on both the side, the collections are robust, and I think the actual picture would emerge once we get the second installment of advance tax in the month of September. So a better analysis can be made around 20th of September once we get the figures for the second installment.
All right, so that was the CBDT chairman. Catch the excerpts of this exclusive conversation all day today only on CNBC TV18. Let's get you an exclusive story then. Sources tell CNBC TV18 that general insurers have submitted the suggestions on expenses of management draft paper. Yash is standing by at the wall giving us all the details. Yash, what are the suggestions made?
So as far as the draft paper is concerned, on August 2nd is when the insurance regulator floated this draft consultation paper suggesting a cap on how much insurance companies can spend. Now, general insurance companies have submitted their suggestions, and there's a major change which has been sought by these large general insurance companies. IRDAI's draft consultation paper suggested capping expenses of management at 30% or an average of the previous 3 years, but whichever is lower out of the two. General insurance companies want this caveat to be removed and have a standard cap of 30% on expenses of management, not having to follow the lower of the two. These large general insurance companies feel that if it will be negative for them if they are mandated to follow the lower of the two, which is 30% or an average of the previous 3 years, and it will only further reduce how much they can spend to acquire business. Now let's understand this by looking at these large general insurance companies and how much they've spent in the previous 3 years. ICICI Lombard has spent 28% of its gross premium as expenses of management. New India Assurance is even lower at 22%, Bajaj Allianz at 23%, SBI General and HDFC Ergo at 21 and 23% respectively. All the large general insurance companies and what they've spent as EOM is lower than the standard EOM limit of 30% suggested by the insurance regulator. As per IRDAI's draft, if they have to choose the lower of 30 or the average of the previous 3 years, the amount that these companies can spend will only get reduced. Even further, that's the concern as far as these large general insurance companies are concerned. Now, instead, if these general insurance companies are given a standard limit of 30% on expenses of management, then how much additional do they get in terms of being able to spend? For ICICI Lombard, the amount could increase by about 360 crore annually. For New India, it's a tall number. It could go up as high as 2,600 crore annually. For Bajaj Allianz, the amount could be 950 crore, and SBI General and HDFC Ergo, the additional EOM amount which they could derive could be 825 and 945 crore respectively.
All right, Yash, thanks a lot for taking us through all of those details. In fact, staying with the insurance space, let's get you some important opinion, and this comes in from Debashish Panda, who's chairman at the insurance regulator IRDAI, and he's talking about exactly this, about the expenses of management. So let's listen in.
We have actually put up an exposure draft. Basically, the whole idea is to, rationalize the expenses so that when the pricing issue of the products is concerned, the customer should get the best price at the end of the day. So how do we rationalize the expenses of management? So we had constituted a working group comprising of industry and other stakeholders, and the regulator, some of our people were also there on those working groups. So the recommendation was there that why don't we have a single cap on the limit of expenses on management. There are some discussions going around the private equity investments into the insurance market. So we are looking at that. There are certain bottlenecks which they have pointed out, and we are looking at that, and we'll take a call very quickly, having discussions with the stakeholders also. So we'll look at the pros and cons, and as I said, very soon we will finalize whatever we have to do as the private equity funds are concerned, and the SPV, whether that is required or it's not required, can it be done away with. All of those are under deliberations and discussions at this point of time.
All right, so important views there coming in on the insurance space. And yes, there is a lot of investor interest in the sector as well. But take a look at the markets at the moment, and Nifty 50 almost 1.9% gain. But one sector which started on a lower note but is really zooming is the IT tech pack. After the financials or the banks, IT is the second best performing and contributing sector in the markets, and Infosys, that is one counter which takes my attention and has been really moving beautifully. With that, it's a wrap on Business Lunch. Mid-Cap Radar is coming up next to take the action forward. Stay tuned for that. Thanks.